Welcome to the ultimate guide to one of the most influential investing books of all time, The Intelligent Investor by Benjamin Graham. If you've ever felt overwhelmed by the stock market, unsure when to buy, when to sell, or whether to invest at all, then this video is for you. This isn't just another summary filled with flashy investment tips or get-rich-quick tricks. Instead, we're diving into a timeless philosophy, a mindset that has helped millions build lasting wealth through calm, calculated decisions. Written over 70 years ago and still relevant today, this book has shaped the thinking of countless investors, including Warren Buffett, who calls it by far the best book on investing ever written. But you don't have to be a Wall Street expert to apply Graham's wisdom. In this video, we'll break down the core ideas of the intelligent investor in a way that's simple, relatable, and actionable, even if you're just getting started on your financial journey. So sit back, take notes if you'd like, and let's explore how you can become a truly intelligent investor, someone who doesn't just survive the market's ups and downs but thrives through them. Imagine a world where the chaos of the stock market doesn't shake your peace of mind, where every market boom or crash doesn't send you into panic or euphoria. Instead, you make calm, calculated decisions that gradually build lasting wealth. That's the core philosophy of The Intelligent Investor by Benjamin Graham. First published in 1949, this book has become a timeless classic, not just because of the strategies it teaches, but because of the mindset it cultivates, one of discipline, patience, and rationality. Benjamin Graham, widely considered the father of value investing, didn't write this book to help people become rich overnight. Instead, he wanted to arm readers with the intellectual tools to build a strong financial foundation that would withstand the tests of time and emotion. At its heart, The Intelligent Investor separates investors into two main camps: the defensive investor and the enterprising investor. Each of these categories comes with its own recommended strategies, risk profiles, and expectations. Let's begin with the defensive investor. This is someone who isn't looking to beat the market, but instead wants to preserve capital and achieve satisfactory returns with minimal effort and risk. For this investor, Graham recommends a simple but powerful strategy. Divide your investments between high-grade bonds and common stocks. The exact ratio can shift depending on market conditions and personal temperament, but the idea is to stay diversified and avoid being overly exposed to market volatility. The defensive investor is advised to avoid individual stock picking unless they have the time and expertise to do so. Instead, they're better off putting their money into low-cost, diversified mutual funds or index funds. These instruments provide broad exposure to the market, reducing the risk associated with any single company. Graham emphasizes that for most people, trying to outsmart the market is a losing game. The defensive investor thrives on consistency, not excitement. On the other hand, we have the enterprising investor. This person is willing to put in the time, effort, and study required to analyze individual securities. The enterprising investor actively seeks out undervalued stocks, often referred to as value investing. This is where Graham's principles really shine. He teaches investors to look beyond market hype and focus on a company's intrinsic value. This value is determined by fundamentals like earnings, assets, and dividends, not short-term price movements. But how do you find a stock that's worth buying? Graham introduces the concept of the margin of safety. This is perhaps one of the most important ideas in the entire book. It means buying stocks when their market price is significantly below their intrinsic value. The gap between the price and the value acts as a buffer against errors in judgment, market downturns, or unexpected news. It's the investor's safety net, ensuring that even if things don't go as planned, the damage is limited. One of the key tools to find undervalued companies is fundamental analysis. Graham walks readers through the process of analyzing financial statements, understanding balance sheets, income statements, and cash flow. He urges investors to focus on companies with strong earnings, low debt, and a history of paying dividends. These indicators suggest a business that is not only profitable but also managed with shareholders in mind. Another cornerstone of the book is Graham's perspective on market behavior. He introduces the character of Mr. Market, a metaphor for the stock market's often irrational behavior. Every day, Mr. Market offers you a price at which he is willing to buy your shares or sell you his. Some days he's euphoric and offers a high price, other days he's depressed and offers a low one. Graham advises you to ignore Mr. Market's mood swings and only take advantage of him when it serves your interests. Don't follow the market, lead it. Graham also discusses the danger of speculation. He distinguishes between investing and speculating and warns that the lines often blur, especially during bull markets. Investing, in Graham's view, is based on thorough analysis, promises safety of principal, and offers an adequate return. Speculation, on the other hand, is based on guesswork, hype, or the hope that prices will rise. While speculation isn't necessarily wrong, it must be done with eyes wide open, and only with money you can afford to lose. The intelligent investor also delves into the emotional aspect of investing. Graham knew that the biggest obstacle most investors face isn't the market, but themselves. Fear, greed, impatience, and overconfidence can all lead to disastrous decisions. He emphasizes the need for discipline and a long-term perspective. Success in investing doesn't come from brilliance, it comes from temperament. One of the more technical but important parts of the book is the discussion on security analysis. Graham explains that stocks are not just ticker symbols, but partial ownership in real businesses. He encourages investors to think like owners. This means looking at a company's earnings history, competitive position, industry dynamics, and management quality. He also recommends comparing companies within the same industry to understand which ones are better positioned for long-term success. The book doesn't shy away from real-world case studies and historical examples. Graham uses past market crashes, speculative bubbles, and periods of economic downturn to demonstrate how his principles hold up over time. He emphasizes that while markets change, human behavior doesn't, and that's what makes these lessons so enduring. One fascinating idea Graham explores is the paradox of risk. In investing, higher risk doesn't always mean higher returns. In fact, investors who chase high-risk opportunities often end up with poor results. The intelligent investor avoids unnecessary risks by buying quality assets at reasonable prices and holding them for the long term. It's not about taking bold bets, it's about making smart ones. Another topic Graham addresses is the importance of dividends. He believes dividends are a sign of a healthy company and provide investors with tangible returns regardless of market fluctuations. A consistent dividend history suggests that a company is confident in its earnings and committed to rewarding shareholders. For investors looking to assess mutual funds or other investment advisors, Graham offers a healthy dose of skepticism. He points out that most professional fund managers don't consistently beat the market. High fees, short-term thinking, and herd mentality often undermine their performance. He advises individual investors to be cautious about handing over control of their money and to always understand where and how it's being invested. Graham's thoughts on inflation are also crucial. He acknowledges that inflation erodes the purchasing power of money, which makes investing even more important. But he also warns against overreacting to inflation by chasing returns in risky assets. Instead, he advocates for a balanced approach that includes inflation-protected securities and high-quality equities. In later editions of the book, commentary by Jason Zweig brings Graham's ideas into a modern context. Zweig connects the timeless principles with recent market behavior, providing insights that help readers apply Graham's wisdom today. He also shares psychological research on investor behavior, further emphasizing that successful investing is as much about controlling your emotions as it is about crunching numbers. Graham also tackles the topic of market timing and dismisses it. He believes trying to predict market movements is a fool's game. Instead, he advocates for dollar-cost averaging, which means investing a fixed amount at regular intervals regardless of market conditions. This strategy removes emotion from the equation and ensures that you buy more shares when prices are low and fewer when they're high. Throughout the book, Graham's tone is calm, wise, and reassuring. He doesn't promise quick riches or market-beating strategies. Instead, he encourages readers to build a solid financial base, avoid big mistakes, and let the power of compounding do its work. His advice is conservative, but it's built for longevity. So what does it truly mean to be the intelligent investor? It's not about chasing the hottest stock or reacting to every news headline. It's not about having insider tips or high-frequency algorithms. It's about developing the right mindset, staying disciplined, avoiding emotional decisions, and understanding the real value behind every investment. Benjamin Graham doesn't promise that you'll become a millionaire overnight. But he does promise that with patience, rationality, and the courage to go against the crowd, you can achieve financial security and peace of mind. And isn't that what we're all really after? Whether you're a complete beginner or a seasoned investor, Graham's wisdom is a reminder that success in investing doesn't require genius, just good habits, clear thinking, and the willingness to stick to sound principles when it matters most. If this summary helped you understand the intelligent investor a little better, consider subscribing to the channel for more deep dives into classic personal finance and investment books. Let's grow wiser, wealthier, and more financially free together. Thanks for watching. Please don't follow me if you want to stay broken and middle class.